Welcome to the deep dive. Today we're jumping straight into Cleveland-Cliffs Q3 2025 earnings. Kind of a paradox here. They missed on revenue, $4.7 billion versus the $4.9 billion expected. But the stock, it soared, went up, as high as 24%. So our goal is to unpack what exactly in the guidance and strategy got investors so fired up.
Yeah, it's a classic case, isn't it? Investors basically looked right past the revenue miss. They focused on, the operational momentum and some really big announcements about the future.
Okay, let's break down the Q3 numbers first, the bottom line. They had a GAAP net loss of $234 million. GAAP is, the official number, but the market seemed more interested in the adjusted net loss.
Exactly. And that adjusted net loss actually met expectations. It's $11.45 per share, $223 million total. And that adjusted figure, it smooths out some of the noise, right? One-time things. It gives a clearer picture of the core business performance, and investors clearly liked what they saw there.
And the sign of that better performance was the jump in operations quarter over quarter.
Right. This is where it gets interesting for investors. Adjusted EBITDA, it jumped 52% from Q2. Went from $94 million up to $143 million in Q3. That kind of dump signals real improvement. Better margins, better efficiency. They're executing better.
Okay, looking at the steel segment itself, shipments were steady, 4.0 million net tons. But the price they got per ton, that went up.
It did, yeah. Average net selling price, or ASP, climbed by $17 a ton to $1,032. But here's the really key point. That wasn't just the market lifting prices. It was entirely driven by a better sales mix. They sold more valuable stuff. And liquidity looked solid, too, ending the quarter with $3.1 billion.
So that better mix, you'd have to assume that's the auto sector kicking in.
Absolutely. Q3 saw their highest auto shipments since way back in Q1 2024. Direct auto sales were, 30% of their revenue? That's significant.
And this isn't just a temporary blip based on the contracts they've signed.
No, definitely not. They've locked in multi-year fixed-price deals with all the major car companies. We're talking agreements running through 2027, maybe even 2028 for some. So it's not just more volume now. It's secured pricing for years. That's huge for predictability.
Plus, they have the facilities for, right? The coating capacity.
They do. Most automotive coating capacity in North America, actually.
Look, yeah.
And critically, all the steel itself comes from their BF-BOF mills, blast furnace, basic oxygen furnace. That matters a lot for cars because you get, frankly, better surface quality. Essential for those visible panels. It's a quality advantage.
Now, the CEO didn't shy away from linking this to policy, did he?
No, not at all. He was very direct. He tied the recovery to the, quote, new trade environment implemented and enforced by the Trump administration. That it made the U.S. Hostile territory for dumped steel from abroad. Pretty strong words for an earnings call.
It certainly is, directly connecting finance to politics.
Yeah, and for you listening, it raises that question, right? Does tying your success so explicitly to one administration's policies add risk? Management is betting those protections stick around, obviously.
And they even pointed to an event in another industry to back up their domestic focus, that aluminum mill fire.
Right, the CEO brought that up. Argued it showed how fragile global supply chains can be, especially for aluminum and automotive. The disruption apparently validated Cliff's own integrated American-based model. He even suggested some car makers are now seriously thinking about switching back to U.S. steel for certain parts because of it. That would be a big win for Cliffs.
Okay, so the auto side looks strong, secured for a while. What about costs? How are they managing expenses?
They're definitely cracking down. Updated guidance for 2025 shows real cuts. Capital spending, CapEx, they lowered it to $525 million. That's down from $600 million. And SG&A selling, general, admin, costs also down to $550 million from $575 million, saving cash.
But are those cuts hurting efficiency?
Doesn't seem like it, based on their outlook. They're sticking to their target of reducing steel unit costs by about $50 per ton compared to last year. And that's after accounting for the higher value auto mix. They're projecting operational efficiencies will save around $300 million a year, and they say those changes are already done, implemented.
Okay, now let's get to the stuff that really seemed to excite the market. Two big catalysts coming up. First, this onerous slab contract.
Yeah, this is a big one. Think of it like dropping a weight they've been carrying. They had this contract forcing them to supply about 1.5 million tons of steel slabs each year. And the pricing was tied to a low Brazilian export price. Basically very low margin for Cliffs.
So they were kind of stuck selling cheap slabs instead of more profitable product.
Pretty much. It was dragging down their overall profitability on those tons. But that contract expires December 9th, 2025, very soon. After that, they get those 1.5 million tons back to use internally, making higher margin finished steel for the U.S. market. It's almost like found money starting next year.
Got it. And the second catalyst, this MOU, the Memorandum of Understanding.
Right. This one speaks volumes about the current trade situation. They've signed an MOU with a major global steel company. This foreign player wants access to the U.S. market. But because of trade policies, exporting here is tough. So what do? They have to partner domestically. They're teaming up with Cliffs, using Cliffs' U.S. footprint. It's expected to be, quote, highly accretive, meaning very profitable for Cliffs shareholders. We should hear the final details later this quarter or maybe early next year.
Okay, shifting gears a bit, there was a really surprising announcement too, wasn't there? Taking them outside steel, rare earths?
Yeah, that definitely caught people's attention. The CEO framed it around the renewed importance of rare earths.
Hmm.
Said Cliffs is looking at potential projects at two of their mining sites, one in Michigan, one in Minnesota.
That's a big step for a steel company. What's the strategy there?
It seems to tie directly into national security and supply chain independence. The thinking is, the U.S. shouldn't rely on China, which controls something like 70% of rare earth mining, for these critical minerals. So Cliffs is positioning itself as potentially part of that domestic solution. It's a strategic play, aligning with national priorities.
And speaking of national priorities, there was another defense-related contract too.
That's right, a different angle, but still significant. They landed a 5-year fixed price deal with the Defense Logistics Agency, part of the DoD. It's worth up to $400 million.
For what exactly? It wasn't just regular steel, was it?
No, it's for something very specific.
Ooh.
Domain-refined, grain-oriented electrical steel. GOES, for short. Basically, super specialized steel that's critical for things like power transformers, essential grid infrastructure, stuff the military needs for strategic reserves. And here's the kicker. Cliffs is the only U.S. producer of this stuff. So that $400 million, it's guaranteed. High margin revenue, totally separate from the usual steel market cycles. Big deal for stability and their strategic importance.
Okay, so lots of positive momentum in the U.S., but not everything is perfect, right? What about Canada?
Yeah, Canada remains a weak spot. It's about maybe 9% of their sales, but performance there is still disappointing. Management points the finger squarely at the Canadian government, says they're not doing enough about dumped steel imports.
So the opposite of the U.S. situation, policy-wise.
Exactly. Imports apparently make up something like 65% of the Canadian market. It's a stark contrast. You see protectionism boosting the U.S. side, while according to Cliffs, lax enforcement is hurting them up north.
And domestically, beyond the strong auto market, what's the outlook for other sectors? Construction? Manufacturing?
Management admitted those areas are still weak, called them recession-like actually over the past year. But they seem optimistic these sectors will eventually follow auto upward as the economy finds its footing. For Q4, shipment guidance is basically flat compared to Q3, around 4 million tons. They expect normal holiday slowdowns, but think improving demand will mostly offset that.
All right, so summing it all up, Q3 looks like a real turning point. Auto demand locked in, costs under control, trade wins at their back. It sets them up not just for recovery, but potentially, much stronger profits and cash flow in 2026.
Yeah. I mean, if you step back and look at the big picture from this deep dive, it's clear that a company like Cleveland-Cliffs, their future isn't just about steel prices anymore. It's deeply tied to U.S. trade policy. It's tied to national security needs, steel for defense, maybe even those rare earths. It's a whole new dimension beyond just commodities.
It really shows how complex things get when corporate strategy, national goals, and, well, global politics all intersect. Hopefully this deep dive helps you understand why that revenue miss wasn't the whole story for investors. Thanks for joining us.